Bitcoin veteran predicts a shocking price target in 45 days. And if you think the danger is whether that number ends up being right or wrong, you're already focused on the least important part. The real danger is what that prediction does to you while Bitcoin keeps hovering between $88,000 and $90,000, pulling you into decisions that feel logical in the moment and brutal in hindsight. Because let me be very clear from the start, the fastest way people lose money in crypto is not believing the wrong forecast. It's letting a forecast compress their time horizon until every candle feels like a verdict on their intelligence. And right now, this market is designed to do exactly that. If you've watched Bitcoin creep toward 90,000, stall, pull back, then do it again. And each time you feel a little more irritated, a little more impatient, a little more tempted to just do something, this video is aimed directly at you. Not to hype you up, not to calm you down with empty reassurance, but to explain what's actually happening beneath the surface, why this range keeps faking you out, and how to avoid becoming collateral damage while everyone argues about price targets. Let's drop you into the exact moment this usually breaks people. It's late December. You wake up, check your phone, and Bitcoin is sitting just under 90,000 again. Not collapsing, not breaking out, just sitting there like it's waiting for you to blink. Your brain immediately starts narrating. You tell yourself this feels like pressure building. You tell yourself too many people are watching this level for nothing to happen. You tell yourself that if it breaks, it won't give you time. Then it nudges higher. Not enough to celebrate, but enough to activate that familiar tension in your chest. Enough to make you think, maybe this is finally the move everyone's been waiting for. And then it snaps back. Not gently, not slowly, just hard enough to erase the excitement and replace it with doubt. Doubt about whether you should have acted. Doubt about whether you acted too early last time. Doubt about whether you even understand what you're watching anymore. That emotional whiplash is not an accident. And until you understand why it exists, this phase will keep taking something from you, whether it's money, confidence, or patience. Now let's talk about the headline that poured gasoline on this fire. Tom Lee saying Bitcoin could double in roughly 45 days. Most people latch onto the number, 200,000. It's clean, it's dramatic, it's easy to repeat. But the more important part isn't the number, it's the clock. 45 days is not a long-term investment thesis. It's a pressure window. It's essentially saying if this happens, it happens fast. And when people believe something might happen fast, they stop behaving like investors and start behaving like contestants in a game show with a countdown timer. They front run, they increase size, they shorten their patience, and the market changes its behavior in response. Here's something most people don't want to admit. Loud, short-term predictions don't just describe volatility. They often amplify it. Because when too many people expect the same outcome on the same timeline, the market has two very efficient ways to punish them. It can delay the move until people give up, or it can fake the move, pull people in, and then reverse just hard enough to force them out. And if you're honest with yourself, you know which one we've been living through around 88 to 90,000. Those morning pushes that look like a breakout starting, followed by sharp retracements that kill momentum, aren't random. They're symptoms of positioning. Price doesn't move to reward your prediction. Price moves to find stress points. And right now, 90,000 is a massive stress point. Think of it like a crowded doorway. Everyone wants through. Some people are pushing forward. Some are bracing to defend their spot. And in the middle, things get chaotic. The market doesn't care who's right. It cares where liquidity is easiest to access. And that's why understanding who benefits from these moves matters more than understanding who sounds smartest online. Let's make this personal for a second. When Bitcoin keeps teasing a breakout and then pulling back, it creates frustration. Frustration leads to impulsive decisions. Impulsive decisions are where money leaks out. The most damaging mistakes don't usually come from panic selling at the bottom. They come from revenge positioning. You get faked out once, so the next time you size up. You get wicked out, so the next time you move, you're stopped just a bit. You feel late, so you chase the candle. Each reaction feels justified on its own. Together, they turn you into someone the market can read easily. Predictable traders are profitable for the market, just not for themselves. And that's why this range feels personal, even though it's not. Now, let's clear something up about Tom Lee, because this matters more than people realize. When he talks about fast upside potential, he's not saying this is guaranteed. He's saying the conditions exist for something violent if certain triggers fire. That's a setup, not a promise. And setups can sit unresolved far longer than people expect. What hurts people is not believing him. What hurts people is abandoning their own process because they think they're about to miss something historic. You stop thinking in months or years, you start thinking in days, sometimes hours, and once that happens, emotion quietly takes control. Let's talk about why the 88 to 90,000 range is such a psychological trap. Round numbers matter. They matter because humans love clean lines. They matter because that's where leverage piles up. That's where stops cluster. That's where narratives collide. So when Bitcoin approaches 90,000, it's not just buyers and sellers meeting. It's expectations slamming into each other. Some people are convinced this is the last barrier before liftoff. Others are convinced it's distribution before a bigger drop. And the market feeds on that disagreement. Because while people argue, liquidity builds. While people argue, emotions rise. While people argue, mistakes multiply. Here's the part that surprises people. This kind of chop can actually be constructive later, but only if it serves a purpose. And the purpose is exhaustion. Not physical exhaustion, emotional exhaustion. It's about making you tired of watching, tired of waiting, tired of being wrong twice in a row. Markets rarely start big moves when everyone feels confident. They start when people feel worn down. That's why the strongest runs often come right after phases that feel pointless and manipulative. Phases that make you wonder if it's even worth paying attention anymore. Now let's talk about the 4-year cycle idea that keeps coming up. You've probably heard some version of this. If Bitcoin breaks a certain level in January, the cycle is dead. It sounds dramatic, it sounds historic, it sounds like you're watching the rules of the game change in real time. But here's the grounded way to think about it. Cycles are not laws of nature. They're patterns that formed under specific conditions, and conditions change. Bitcoin has ETFS now. Bitcoin has deeper institutional access. Bitcoin exists in a very different regulatory environment than it did years ago. So yes, patterns can stretch, compress, or distort. But betting everything on a clean, obvious cycle break moment is dangerous. Markets don't like clean transitions. They prefer messy ones. Instead of asking whether the cycle is dead, ask a more useful question. What would have to change for this market to stop snapping back every time it tries to move higher? The answer is not hype, it's participation. Big moves need buyers who stay buyers after the first push, not just people chasing the breakout candle. So far, that follow-through hasn't stuck. That's why you keep seeing wicks instead of trend. Now let's get practical, because this is where most people either lock in clarity or spiral deeper. If you're watching this range and trying to label it bullish or bearish, stop staring at the ceiling and start watching the floor. The ceiling is obvious, around 90,000. The floor is where the story is written. If dips get bought faster and the lows stop drifting lower, pressure builds. If dips bounce but each low is weaker than the last, risk increases. Same ceiling, completely different implications. This is how you stop letting one number hypnotize you. Now I want to pause here and say this clearly, exactly as required, because it needs to be heard at this point, not hidden at the end. This might shock you, but I'm not a financial advisor and nothing in this video is financial advice. Cryptocurrencies are highly volatile and you could lose all the money you invest. You should always do your own research and consult a qualified professional. After all, your investments are entirely your responsibility, and you should know that nothing is ever guaranteed when it comes to investing. Neither I, this channel, nor YouTube are liable for any losses, and this video is for entertainment and educational purposes only. Now back to the part that actually helps you stay sane. There's a mistake a lot of smart crypto investors make during phases like this. They think the solution is more analysis, so they watch more charts, they read more posts, they track more data, and instead of clarity, they get overload. You don't need to understand everything that's happening. You need to understand what matters for your behavior. Here's a simple filter you can use right now. If Bitcoin moving $3,000 or $4,000 in either direction would cause you to panic, freeze, or act impulsively, your exposure is too large for this phase. Not too large for Bitcoin, too large for you. That's not weakness, that's self-awareness, because this phase is not testing your intelligence. It's testing your emotional tolerance. Now, let's talk about how moves like the one Tom Lee hinted at usually begin, because this is where most people completely misread the market and end up positioned the worst at exactly the wrong time. Most people imagine a clean breakout, a clear level breaks. Headlines follow, price runs. Everyone nods and says, yep, that makes sense. It feels logical, it feels earned, it feels like the market rewarding patience. That version almost never happens. Reality is messier and more uncomfortable, and a lot more psychological. What usually happens first is boredom. The market chops. Sideways, up a bit, down a bit, nothing dramatic enough to feel important, but just enough movement to keep you watching. Days pass, sometimes weeks. People who were excited start checking the price less. Conviction doesn't disappear all at once, it erodes quietly. Then interest fades. People stop talking about upside and start talking about frustration. You hear things like, this range is exhausting, or nothing ever happens, or maybe the move already happened. That's not bearishness yet. That's fatigue. And fatigue is dangerous because tired people make sloppy decisions. Confidence erodes next, not in the loud, dramatic way, in the subtle way. You start second-guessing ideas that felt solid before. You start wondering if the level actually matters. You start telling yourself you'll just wait until something is obvious. This is the part where most people mentally disengage, and then comes the move almost no one is emotionally prepared for. A sharp move that feels wrong, not a clean breakout, not a reassuring climb, a fast, aggressive move that goes against what people expect, a move that scares people who were waiting, a move that punishes people who chased the wrong moment. It looks like failure, not success. It feels like confirmation that the range was distribution. It feels like proof that patience didn't matter. It feels like the market slamming the door shut. And that's exactly why it works, because that move creates fuel. It forces weak hands out. People who were already tired finally give up. People who were over-leveraged get cleared out fast. Stops get hit. Positions get closed, not because people changed their thesis, but because they couldn't handle the pressure. Leverage disappears, overconfidence disappears, noise disappears, and suddenly there's space. Space for stronger hands to step in without fighting a crowd that's all leaning the same way. Space for price to move without constantly snapping back. Space for momentum to build quietly before anyone wants to believe it. That's why the most dangerous moment for you is not the drop itself. The drop is obvious, the drop is loud, the drop feels scary, but at least it's clear. The most dangerous moment is what comes after. It's the moment when price stabilizes and you tell yourself, I'll wait for confirmation this time. It's the moment when you promise yourself you won't get tricked again. It's the moment when you decide you'll only act once it feels safe, because confirmation feels safe, and safety is expensive. By the time something feels obvious, the risk has already shifted onto you. The easy decisions are gone. The clean entries are gone. What's left is chasing strength or hesitating until price runs without you. That's why obsessing over price targets usually does more harm than good. Targets give your brain something concrete to fixate on, but markets don't move to satisfy targets. They move to resolve imbalance. So instead of obsessing over whether 200,000 is realistic or whether 90,000 breaks today or next week, Shift your focus to process. Process is the only thing you control when price is unpredictable. And this is where those 3 questions matter more than any chart or prediction. Ask yourself 3 questions the next time Bitcoin flirts with 90,000 and don't rush past them. Don't answer them automatically. Sit with them longer than feels comfortable because these questions aren't about prediction. They're about control. And control is the only real edge most people ever get in markets like this. First question, am I reacting emotionally or following a plan? This sounds simple, almost too simple, which is why people underestimate it. In the moment, emotional reactions are incredibly convincing. They dress themselves up as logic. You tell yourself you're being rational. You tell yourself you're responding to new information. You tell yourself this time is different. But if you zoom out and look at your behavior over a few weeks, patterns appear. If your decisions change every time price moves a few $1,000s, that's not flexibility, that's reactivity. That's your nervous system trading for you. A reaction only exists because something just happened. A plan exists before anything happens. A plan already knows what it will do if price goes higher. It already knows what it will do if price drops hard. It already knows what it will do if price goes nowhere for an uncomfortably long time. A plan doesn't care about every tick. It doesn't need constant stimulation. It doesn't panic when nothing happens. And if you don't have that, the market will happily provide you with endless reasons to react. Because this phase is not designed to test whether you're smart. It's designed to test whether you're disciplined. So when Bitcoin pushes toward 90,000 and your heart rate picks up, pause and ask yourself this honestly. If the price froze right here for the next 2 weeks, would I still feel good about what I just did? If the answer is no, you weren't following a plan. You were chasing relief from discomfort. Second question, if this drops hard, will I regret my position size? Notice the wording, not will I regret buying, not will I regret believing, but will I regret the size? Because most pain in crypto doesn't come from being wrong on direction. It comes from being right on direction but wrong on size. You can believe in Bitcoin long term and still lose sleep if you're oversized. You can believe in upside and still panic if a drawdown feels personal. So imagine this clearly. Bitcoin drops $5,000 in an hour. No warning, no explanation, just a fast move down. What happens inside you? Do you tense up? Do you start bargaining with yourself? Do you immediately look for reasons to justify selling or doubling down? If the answer is yes, your position size is dictating your emotions. And when emotions dictate decisions, the market has leverage over you. A healthy position size doesn't eliminate fear, but it keeps fear from controlling you. It lets you think. It lets you wait. It lets you respond instead of react. And that matters more than being early. Third question, am I trying to win this week or still be here next year? This question cuts through everything because when markets get noisy, time horizons collapse. You stop thinking in years. You stop thinking in cycles. You start thinking in days, sometimes hours. And that's when people sabotage themselves. Trying to win this week makes every pullback feel like failure. Trying to still be here next year makes pullbacks feel like part of the terrain. One mindset turns volatility into an enemy. The other turns it into a cost of admission. If your goal is to win this week, you will overtrade. You will overreact. You will feel constantly behind. If your goal is to still be here next year, you make decisions that prioritize survival over excitement. Those 3 questions don't give you certainty. They give you alignment. And alignment is what pulls you out of the noise when everyone else is drowning in it. Now let's close the Tom Lee loop properly, without hype and without dismissal. Could Bitcoin hit 200,000 in 45 days? Yes, it's possible. But here's the more important takeaway, and this is where people keep getting it wrong. If Bitcoin ever does something like that, it will not feel comfortable while it's happening. It will not feel fair. It will not feel orderly. It will not wait for consensus. It will feel fast, chaotic, and emotionally exhausting. You won't feel clever for being early. You'll feel anxious about whether it's real. You won't feel calm holding through it. You'll feel pressure to do something before it's too late. That's how sharp moves work. They don't reward emotional readiness, they punish it, which is why the real decision you're making right now has nothing to do with whether you believe a number on a timeline. The real decision isn't whether a prediction comes true or not. The real decision is what kind of investor this phase turns you into while you're living through it. Because markets don't just move price, they shape behavior. This phase is quietly asking you a question every single day. Not out loud, not in a headline, but in the way price moves, stalls, fakes, and tests you. Are you becoming more reactive or more grounded? If this phase turns you into someone who chases every push, who feels relief when price goes up and anxiety when it goes down, who needs constant confirmation just to feel okay holding a position, then even the strongest bull market won't save you, because you'll never actually participate in it cleanly. You'll buy late because you need proof. You'll sell early because you need comfort. You'll hesitate when it matters and rush when it hurts. And none of that feels reckless in the moment. It all feels justified, sensible even. But stacked together, those small emotional decisions quietly hand your edge back to the market, one trade at a time, one adjustment at a time, one just this once reaction at a time. That's how people lose in bull markets without ever realizing what went wrong. But if this phase turns you into someone different, someone who can sit with uncertainty without needing to resolve it immediately, someone who can stick to a plan even when the market refuses to give instant feedback, then something important changes. You stop needing the market to reassure you every day. You stop confusing movement with meaning. You let price do what it does without demanding that it perform on your schedule. And that doesn't make you passive, it makes you durable. Because durability is what lets you stay positioned long enough for big moves to actually matter. If the next 45 days explode upward, durability keeps you from sabotaging yourself on the way up. If the next 45 days grind sideways and frustrate everyone, durability keeps you from giving up right before conditions change. Either way, you're still in the game, and that's the part most people miss. Being right on a headline feels good. Being durable through uncertainty builds real outcomes. Durability compounds, predictions don't. That's why this 88 to 90,000 range isn't a verdict on Bitcoin's future. It's not telling you whether the bull market is alive or dead. It's a negotiation between patience and impulse, between planning and reacting, between conviction and exhaustion, and negotiations are never quiet. They're loud, they're messy, they drag on longer than anyone wants. They test patience far more than they test belief. So if you're frustrated right now, if you feel worn down, if you catch yourself thinking something has to happen soon, that doesn't mean you're failing. It means the market is doing exactly what it's designed to do. The only real mistake is letting that frustration start making decisions for you. Watch the next video.